Unfortunately, becoming profitable is really simple. There are only three things that can stop you from making money in trading. But most traders spend years trying to fix the wrong thing. Because when trading is not working, it rarely looks like one clear problem. It looks like something new every week. You have a losing period and suddenly the entry does not feel precise enough. Then you miss a larger winner, and now the rules feels too restrictive. You're looking at a real result and trying to prevent it from happening again. So you make a small adjustment. Maybe the entry needs one more confirmation. Maybe the setup should still count when one condition is missing. Then the next group of trades creates the opposite problem. The extra confirmation makes you enter too late. The rule you relaxed gives you more setups, but some of them look terrible afterward. So you adjust it again, and every change is connected to something that actually happened. That is what makes the process feel intelligent. You could explain every decision, but after enough time, the strategy becomes a record of everything that recently occurred. A bad week adds a filter, a missed winner removes one. Then psychology enters the picture. Maybe the strategy is fine and you are simply not disciplined enough. So now you are reading about confidence and trying to control your emotions. But the account still does not become consistent. So you return to the charts and find something else that might be missing. This can continue for years because there is always another explanation available. Whatever becomes painful most recently becomes the next thing to fix. Some of those changes may genuinely help, but without a clear order, you can spend years solving real problems that were never producing your current result. So before you change anything else, there is one question that has to be answered first. And if the answer is no, everything you are currently trying to fix comes too early. The first question is simple. If you follow the exact same rules over a large enough sample, will those rules actually produce money after trading costs? This sounds obvious, but a lot of traders never get a clean answer. The results are mixed with live judgment. They skip setups because the market looks strange. So when they look back at the account, they cannot tell what produced the result. The strategy needs to be tested without your opinion changing the rules from trade to trade. The entry has to mean the same thing every time. The exit has to be measured the same way. Then you need enough trades for the result to stop depending on one lucky winner or one terrible week, which starts around 300 to 500 trades. And once you have that, the math is simple. Your win rate multiplied by your average win minus your loss rate multiplied by your average loss. Then spread and commission come out of the strategy. For example, a strategy with 40% win rate at 2-hour average winner produces 0.2 hour per trade before costs. Change the average winner to 1.4 hour and the expectancy drops below 0 before costs are even included. Both can have profitable weeks and will have profitable weeks. The recent sequence does not answer the question, only the full sample does. And that sample has to include the ugly trades, the clean losses, the periods where the strategy appears to do nothing. You cannot build a result from the trades you like and treat everything else as an exception. If the result is negative, that is where the investigation stops. There is no psychology book that can repair it. That answer may be uncomfortable, but at least it tells you exactly where the work belongs. But even with a clean yes, the live account can still look nothing like the test. Because let's say the rules produce positive expectancy over a large sample. The numbers still work after spread and commission. But then you start trading live, and the account looks like nothing like the backtest. Because the backtest only gives you the result of the exact decisions you tested. It does not give that result to every trade that looks similar. Maybe the tested entry happens after a candle closes. Live, the setup looks obvious, so you enter a little earlier. Maybe the rules say every valid setup has to be taken. Live, one of them looks weak, so you skip it. Neither decision has to look reckless. Those results reward the deviation and make it feel like your judgment improved the strategy. And this can stay hidden because everything still looks close enough. You use the same general setup, you still call it the same strategy, but the data belongs to one version and the live account is receiving another. Eventually, the early entry gets stopped before the tested entry would have triggered. One skip setup becomes the winner that was supposed to pay for several losses. The live result falls behind without one dramatic mistake to blame. Just a series of reasonable decisions that slowly change the system. So, take the outcome away for a moment. Place a live trade beside the historical sample without showing whether it won or lost. Will someone be able to identify both as the same setup, following the same rules, the same entry and exit definitions? If the answer requires an explanation about why this situation was slightly different, the live result does not fully belong to the tested strategy. And that gives you a cleaner diagnosis. If the strategy produced an edge, but your live trades does not match it, rebuilding the strategy is the wrong fix. The gap is happening after the research. The profitable system exists. It is simply not reaching the account consistently. But even when the edge is real and the same strategy reaches the live account, the account can still collapse before enough trades arrive. Because now we have an edge, and the live trades matches the rules that produce the data. At this point, it feels like the difficult part should be over. The edge might be clear across 300 trades, while the next 10 still look terrible. Imagine a system with 40% variance. 6 losses in a row can happen without anything being broken. Even 10 in a row can happen without anything being broken. Now imagine risking 1% per trade. After those 6 or 10 losses, if you are trading a prop firm account, you are almost blown your account or you already blown it. But even if you haven't blown it, the next trade no longer feels like one normal result inside a large sample. It feels like the trade that needs to save the account. So you take profit early because you cannot afford to give anything back. Now the execution starts moving away from the data. The strategy still has the same edge. The risk made its normal distribution impossible for you to continue trading. This is why risk cannot be chosen only by asking how much money you want to make. You need to know what the strategy can realistically do before it pays you again. How long can the losing streak become? How deep can the drawdown go while the edge is still alive? If your risk only feels comfortable during an average month, it is too high. The account has to remain alive, and you also need to remain capable of taking the next valid trade the same day. Because after enough pressure, the rules start looking optional. The stop suddenly feels too wide. The target feels unrealistic. So mathematically survivable risk can still be unusable for the person trading it. And sometimes the fear is a reasonable response to a ridiculous exposure. You can read about trading psychology for hours. You will still know how much money is at risk. The cleaner solution is often to reduce the amount until a normal losing period stops feeling like an emergency. The useful question is, what risk let me trade the full distribution without changing the system halfway through? Because the edge does not appear on demand. It appears after enough repetitions. Once the risk gives those repetitions enough time to happen, what exactly will the fourth problem even would be? Discipline sounds like a separate problem, but follow it until it reaches the account. A lack of discipline makes you enter outside the rules or interfere with trades that were already planned. That is execution. Psychology sounds separate too. Fear may make you skip a valid setup, or the fear may be coming from exposure you cannot tolerate. It eventually lands inside execution or survival. And this is why the exact same symptom can require completely different fixes. 3 traders can show the same drawdown. One may be trading a strategy with negative expectancy. Other may be changing the rules live. The third may be experiencing normal variance with a risk level they cannot survive. The account curve looks similar. The diagnosis is completely different. That is why the order matters. Start with the strategy. Does it even produce positive expectancy through fixed rules, enough data, and realistic cost? If the answer is no, stop. Nothing after it can rescue it. If the answer is yes, compare the live trades with the trades that produce the data. If they do not match, stop them. Only after both answers are yes, does the risk question matter. Can the account and the trader survive the full distribution? And once you run the questions in that order, every new piece of trading advice becomes easier to judge. Does it improve the edge? Does it make live execution match the system? Does it help the strategy survive its normal distribution? If the answer is none of them, it cannot change the final result. That is the unfortunate part. Becoming profitable is really simple. The strategy needs to make money. That strategy needs to reach the live account. And the risk needs to give the edge enough time to appear. Once all 3 answers are yes, there is no fourth problem left to solve. The rest is repetition.